The stock market has been absolutely brutal lately, with many stocks just tanking by 50, 60, 70, and 80%, and some even more. We have some of these powerhouse companies like Facebook, Netflix, Microsoft, and Google just getting absolutely destroyed. It's been a brutal 2022 for stocks so far. In this video, we're going to take a look at some important data to find out when this stock crash disaster might end. So the first thing that I want to look at is margin debt. So basically, this is FINRA margin debt. It shows you how much margin is currently out in the markets. Margin is... it's like a good thing and a bad thing. If it gets too excessive, it can pose a very big risk to the market as a whole. But at the same time, margin, when it's used correctly and in a smart way, can be a good boost for the markets. So check this out. Over the past 2 years or so, the margin debt values have been all over the place. Of course, when the market crashed in early 2020, margin debt fell as people got margin called and stocks tanked, and it was just a giant disaster. There was a lot of uncertainty as well. But however, in October of 2021, that was like the peak margin levels, and there was around $935 billion in margin debt. Since then, that $935 billion in outstanding margin debt went all the way down to $835 billion. So I guess you could say we saw a total loss of around $100 billion in margin debt, which is good and bad. It's good that it's calming down, but it's also bad because, you know, when we look at some of these stocks, some of this margin debt was likely, I guess you can say, closed out because some of these stocks just fell by insane amounts. I mean, it's not like we're just seeing growth stocks fall, but we're even seeing some of these more well-established companies like Square and Facebook fall by 50% or even more. So that's one interesting thing to see. Another thing I observed from this data is that margin debt, for the most part, over the past 5 years, has been rising pretty steadily. Part of this, I believe, is due to inflation. For example, we can see like in the peak of 2018, there was around $669 billion in margin debt. Where right now, the margin debt is around $835 billion. So I don't necessarily expect margin debt to completely, pull back to its lows back in 2020 or anything like that. Like, unless something absolutely horrible happened. But it is important to note that this data is just showing, like, total value rather than, like anything in terms of like percentages or anything like that. So with inflation as bad as it's been, I can see margin debt just kind of hovering still above like the 2018 level. So we'll see what happens. But margin debt's tanking down a little bit, which is good and bad. Another important thing to know is we have the FOMC event on May 4th. This will be extremely, extremely important. Basically, Jerome Powell will have an opportunity to save the markets depending on what he has to say. Basically, the FOMC events are very, very important because Jerome Powell, like I said, will basically give us what he's seeing in the markets and what he plans to do to make the economy as good as possible and to hopefully keep stocks up. So this event is on May 4th. The market is currently pricing in a 96.5% chance of a rate hike of 75 to 100 basis points. So that's pretty big, but again, it's being priced in. So if we only see a rate hike of like 50 basis points, that can be seen as a very dovish tone by the Feds, and that could boost stocks up, but it all depends on what Jerome Powell has to say. In the past, he's made the stock market rise a lot off of these events, but there have also been a couple notable times where the stock market did not react well at all to these types of events. So it's kind of hit or miss, but for the most part, Jerome Powell does do a pretty good job. So keep that in mind. Another important thing that we have to watch is these big earnings. So for those of you who don't know, we saw Microsoft and Google report earnings yesterday after close, and their reactions were okay. This week we are seeing some of the biggest, most influential companies report earnings. Like I said, Microsoft, Google, Apple, Amazon, and I guess you could say Facebook too. These companies have a very large influence on just the market overall. Especially they have a direct influence on the S&P 500 and of course the NASDAQ and stuff like that. But basically, Microsoft and Apple had decent reactions. Like Google's down 2.6%, which isn't horrible, but it's definitely not good. At the same time, Microsoft is up around 7%, which is really good. The main thing is if these powerhouse companies at least hold their ground, stocks should do fine. If they rise up, that would be awesome because they have such a large influence on the S&P 500. So check this out. Right now we're looking at a heat map of the S&P 500, and we can see, for example, Apple it has a large influence. Like the bigger the box, it shows the more of an influence that stock has on the S&P 500. So if we look at Apple, obviously big box, and if we look at, let's say, Qualcomm, the box is relatively small. So these giant companies like Apple, Microsoft, Google, and Amazon, we need them to do good because if they don't, that will be really bad. Okay, so keep that in mind. And of course, Microsoft and Google already reported, but we do have Apple and Amazon on Thursday after close, and we have Facebook after close today. Keep that in mind. In terms of next week, we have some other big companies reporting like AMD, Pfizer, Uber, stuff like that, Block or Square, and then we also have the FOMC event. So, of course, no one knows what the exact bottom will be in the stock market, but we do have some very important events coming up, like I said, with the FOMC event and Jerome Powell. And then, of course, these big earnings will have a strong influence. At the same time, margin debt is cooling down a little bit, which, is kind of expected when you see stocks tanking the way they are. So lots of big things are happening. Looking at the S&P 500's movement, honestly, the chart looks like it can definitely continue lower, and I hate to say that, but it's not looking good at all. We're kind of doing like a double bottom on the S&P right now. So the first bottom, I'll highlight it right here. So like, let's say we take this, like square right here. We can see the first bottom was right around here, and then now it looks to be the second bottom. And normally this is kind of like a bearish sign because it tried to hold this support right around 420 once, and then it's kind of coming back down. So like we're seeing lower highs as well too. So it's looking tough. Another really important thing I want to point out is basically here. Let me just remove this so it's more clear to see. But what I found very ironic is how when Russia invaded Ukraine, while that it was a horrible event, that was actually the bottom of the stock market. So this little white circle right here on February 24th represents the day Russia invaded Ukraine, and that was the bottom. So what it goes to show you is that a lot of times the stock market prices things in and it looks into the future. It's forward looking, and a lot of times it prices in the worst, right? It prices in the worst. So what we can see is, let's say we have Jerome Powell hike rates by 75 basis points. While that is a pretty substantial rate hike, if the market's already pricing that in, that can still be a bullish sign. So keep in mind that the stock market is always forward looking for the most part. Like, remember, when Russia invaded Ukraine, that was the bottom of the stock market, at least for now. So we'll see what happens. The stock market's going crazy. And remember that with everything, there's opportunity in the midst of chaos. Stock downturns and stock crashes can be an amazing opportunity if you play them in the right way. If you're trying to day trade every little move with Facebook or Apple or Microsoft or whatever, it's just, you're not going to take full advantage of the opportunity you have at hand. There's so many stocks at amazing levels right now, whether it's whatever, look around, do some research. There's a lot of stocks at low levels. You guys know me, I love DraftKings. Of course, it's definitely riskier than a company like Apple or something like that. But even if you look at some of these other companies like Facebook or Square or anything, there's so many deals out there right now. There's opportunity in the midst of chaos. And a lot of times the best way to capitalize on these types of opportunities is buying shares and holding. Look what happened over the past 2 or 3 years with the S&P 500. There was a giant dip in early 2020, and the people who made the most money were the ones who bought during peak fear. So if you see everyone else freaking out and you see analysts saying we're headed for a horrible recession, depression, whatever you want to call it, a lot of times, historically speaking at least, that was the prime buying opportunity. So keep that in mind while you're looking at all of these stocks and while you're analyzing everything. Keep that in mind. Hopefully the stock market pops up. It's been a wild 2022 so far. Make sure to let me know what stocks you guys are watching in the comments down below. A lot of times, the stocks you comment, I end up covering. Also, if you liked today's video or you learned something, make sure to subscribe. I post brand new videos every single day. Besides that, let's have a great week.